we talk a lot about bubbles today as well. And bubbles aren't something which happen over short periods, they happen over very long periods. So the 2007 crisis happened over a 30-year period. And what you've done then is you transitioned all of that debt onto governments. So arguably, the concern we should have today is on the government balance sheet and the level of debt that governments have. So that, in a sense, leads, I suppose, portfolio managers to be a little bit more concerned about the government exposure and how do you diversify that. And you can do that within fixed income by looking at corporate bonds, emerging market debt, high yield. So there's lots of sub-asset classes within that. But then you can also look at the alternative side. And I think you're starting to see a lot more managers looking at that space. So a good example would be infrastructure. And although infrastructure would be considered a equity, some people will look at infrastructure as basically a proxy for bonds. Because if you look at infrastructure projects, they're long-term in nature, and ultimately you've got this visibility on the cash flow, and therefore they tend not to fluctuate as much. Basically, portfolio managers are adapting to the environment, and this comes back to that whole concept of dynamically managing portfolios evolving over time, because ultimately markets don't stay static, and today we live in a world of disruption.